Perfect day to have you in. Not talking about the weather, I'm talking about this move across the curve. 14 basis points. We're at the highs of the year now in US Treasuries. Were you anticipating that?
Well, I think the data has been speaking for itself. Retail sales obviously just sort of reconfirmed the trends that have been coming out in CPI and other inflation data. The U.S. consumer is in good shape. The economy is in good shape. The Fed really has no reason to move at this point in time. The markets, clearly at the start of the year were pricing in, 6 to 7 cuts, and now they're going through that adjustment process to price in, like you said, possibly no cuts. That's where we are right now. So.
What are you anticipating? Do we get a cut in December? Are we back to maybe even a cut by June, like some people suggest is still warranted?
I think, what we're trying to figure out is why the data is still coming strong.
Yeah.
Because even with lags, you should start seeing some indication of things starting to slow down, and you're not, right? So obviously, some of the things are fiscal. The fiscal policy still remains accommodative. Biden just forgave a whole bunch of new student loans recently. Immigration has been a big factor over the last couple of years. You have all these people coming in, something like 6 million people in the last 3 years. They're looking for houses, they're buying cars, the cost of car insurance, health insurance, all of these things, which is what driving up inflation. And I think until you see some of that data calm down, there's no reason for the Fed to move. So we don't think June is likely. We think right now, at the start of the year we were at 2 to 3 cuts. We were never in the 5 to 6 range. Now we're in the 1 to 2, but we think there's a non-zero probability that you might actually get a hike.
Which is such a range of outcomes, right? How do you invest in that kind of environment, and make sure you pick up the basis points that are on offer?
Yeah, I think the main thing for us to focus is you can't live from print to print. You can't live from Fed meeting to Fed meeting. You have to look at the bottom line. The bottom line is the regional bond index has a yield of about 6.4% across both high grade and high yield as a blended index. It has a duration of about 6.2, so that means you've got about 100 basis points of of interest rate increases baked in terms of a break even. So for us, we're happy to just sit, earn the carry, earn that 6.2%, not take a call on interest rates in terms of being overweight or underweight duration, just be market weight. Let the chips fall where they may in terms of interest rates. But if you're earning that 6.25% carry, then you've got a fair amount of protection built into your portfolios.
It sounds like an ideal scenario and enough reward for the risk that you're taking potentially. Are there other spots in the market, be it regionally or more broadly, where you're spotting opportunities like that?
Well, I think you've obviously got story credits. So you've had Egypt obviously been a big factor. Now you've got the Egypt local currency trade that has come in, a lot of people jumping in. Obviously, the strength of the U.S. dollar kind of, brings that a little bit into focus, but that's still a relatively attractive place. You've got some of the sort of restructuring sovereign debt stories in the space. Pakistan is now in a slightly better place than it was, and is giving you good carry and defensive carry in short-dated bonds. So
you're finding, areas of interest in Egypt, in Pakistan. What about the likes of India in election mode right now? Yeah,
I think India is, again, relatively safe place for bonds, particularly, on the banks and the financials, and then some of the renewables are giving you decent yields. For us, primarily right now, it's about playing defense. We're not in it to try to gain capital appreciation, betting on interest rate cuts or declines in rates or spreads. Spreads are extremely tight in the region. We don't expect spreads to get any tighter. So, you're not going to get capital appreciation from either spreads or rates, so it's best to just sit and focus on the carry.
How do you hedge the currencies, though? Because obviously we're seeing, more and more weakness as the days go on.
Yeah, I think obviously if you're taking local currency exposure in some of these emerging market currencies, you kind of have to take a currency view. If you, for example, if you hedge out all of the currency risk in Egypt, you pretty much hedge out all your returns.
Yeah.
So you've got to kind of take that call. Particularly in Egypt, you have the flexibility that you're going in for 3 months or 6 months, relatively short periods of time, and given all the FX inflows, you expect that FX movement to be sort of muted. But in other countries, you have to use the forward markets and try to hedge if it makes sense to do that.